Hey everybody, what's happening? Oh wow, people are rolling in right now. Hey folks, we just flipped on the webinar. We are just going to give everyone maybe a minute or two to join up. This should be really fun. We've had this webinar, scheduled for a while now, and I don't think any of us were quite prepared for like the fact that this would be sort of the first webinar that we at Bitwave were doing after the whole FTX fiasco. But we just so happened to have scheduled this with an expert in the trading and exchange world. So we are very, very lucky to have Yoann here for this. So we'll give everyone a couple minutes to join, and then we'll get rolling.
Cool.
Yeah, how would we have known when we scheduled this that like this would be the most interesting possible time to ever have a webinar?
It's an interesting time, to say the least.
So while people are going, we can chit chat. But I will say, SBF is back tweeting today, which is
Is he? I wish he wouldn't. I wish he wouldn't. I think I've heard enough.
I just look at me purely from the perspective of his future lawyer. I've got to think that he should not be tweeting right now. But
have you understood this whole thing about the WHAT, sort of the what happened? I mean,
no,
it seems like a rehash of like I didn't know anything, and just reminds me of like 2008 or post 2008 subprime, like Goldman Sachs and co just being in front of Congress and saying like, we don't know what happened. Like, it just feels a bit weird. Like,
so it feels a bit weird.
If we're just in the chit chat portion, if we're allowed to peddle unconfirmed rumors from Twitter, there is
it's all we're allowed to do during this portion, Joe.
There is a distinct theory. Well, one, he did make a comment in that New York Times article about that like Twitter thread he's doing. He's like, and he made a comment like, "Oh, I'm making it up as I go along. It's supposed to be kind of cryptic," and then someone else realized that he's, at least this is the accusation on Twitter, that he's using a bot to selectively delete tweets at the same exact time that he is tweeting these little like threaded letters and stuff. And so that his tweet count never changes, so that people don't notice that he's like going back in time and deleting all these tweets from the last week where he was like, oh no, everything's fine, assets are good. Now again, unconfirmed, unsubstantiated Twitter rumors. I have no idea if that's real.
Well, let's get rolling. And actually, someone asked a question, which is the perfect thing to start with, because we were going to do everything else. Joe, why don't we do real quick intros? But let's actually set the stage of what has happened over the last 2 weeks, because I think it will influence a lot of what we are going to be discussing here today.
First of all, okay, yeah, perfect. We'll do quick intros, and we got a lot to talk about, so we'll get right into it. So we're joined here today. This is our statement, which we have to say, which is this is information purposes only, right? We're making neither Bitwave nor Wintermute are making any commitment of services or to do anything. This is also not tax, financial, investment advice. All of those types of disclosures, please, they apply here. This is informational only. And so we're going to talk crypto markets. We obviously the FTX issue, I think we're going to start right off as maybe with a brief recap of that, because we had this booked prior to the FTX situation, and like you said, Pat, we just so happen to have an expert on markets here with us, so it would be foolish to not acknowledge it and kind of talk about the implications of it. I'm Joe Dillion. I'm our director of customer success here at Bitwave. I'm taking a backseat role today. I'm here to moderate. We've got the two big brains in the room here, and I'm going to give them a series of prompts and just let them go. So we have Yoann here from Wintermute. He's a co-founder, and he leads the business development team at Wintermute. And Yoann, if it's okay with you, can you just, especially from the Bitwave side, maybe some of our audience might be less familiar with what does, what exactly does Wintermute do? Can you encapsulate that in a quick, 10, 20 second description?
So in 5 seconds, we make markets more efficient. So essentially, we call a market maker. So we're always there. If you trade on an exchange, or if you call us, you give us a call, we're always there to either buy or sell certain cryptos versus other cryptos versus fiat. That's what we do. So we're always there to provide a market.
Beautiful. Beautiful. And as your intro says here, you have, over a decade in the trading, investing space, advising startups. So certainly the right kind of person we want to be talking to here. And then we also have with us a co-founder of Bitwave, Pat White. He is, all things, how do I say this? Crypto, accounting, finance stack, the whole, suite of tools that we try to provide here at Bitwave. Pat leads those efforts for us. Hi, Pat.
Hey, by the way, I'm going to get new headshots today. So this is like the last time we'll use this shot of me from my mid-20s, back when I had hair and weighed like 50 pounds lighter. So this is like the retirement party for this particular headshot. Everyone enjoy it while you can.
I like it. And that means you got a fresh haircut for us here today.
I got a fresh haircut.
All right. And so I think this is a fireside chat. So I'm going to turn the slides off because really we just want this to be a conversation here. So I think, like you said, Pat, do you want to start with maybe a brief recap of the FTX situation, just because it does kind of sit as a cloud over this whole kind of discussion?
Yeah, I'll throw a recap out, and then Yoann, if I forget anything, feel free to add some color commentary.
Sure.
The high level is that over the course of the past week, FTX as a international series of entities. I think that's really important. So one of the images that's floating around right now is of FTX's subsidiary chart, and it has about 150 different companies, from FTX International, FTX US, Alameda Research, all the different international. I think they have a Hong Kong company, a bunch of other ones. So that entire structure of companies essentially has all gone insolvent over the last 7 days, more or less. The root of it, to add some really interesting intrigue on all of this, the really crazy part about it. So history of FTX started in 2019. This kind of like wunderkind Sam Bankman-Fried. We're going to be calling him SBF for the rest of this talk today. He started it. He raised a absolute metric crap ton of money. There's no other legitimate way to describe it. He raised an enormous amount of money and did not have a board. I mean, this is like a very low oversight kind of like company. One of the companies that he raised money from was Binance, which is, if you know the space, Binance and FTX today are brutal competitors. Back in the day, not so much. So he raised money from from Binance. Binance ended up owning some FTX stock. Fast forward a few years, they were trying to get licensed. They needed their major stockholders to fill out some paperwork. Binance was dragging their feet because suddenly FTX was a major competitor. These were the two biggest exchanges in the world. So FTX ended up buying back the stock from Binance that they owned. And what they did is they bought it for a combination of cash and a token called FTT, which is the exchange native token for FTX. Fast forward a few more years, on November 2nd, Alameda Research, which is one of the sister companies in this whole subsidiary group, their balance sheet got leaked onto CoinDesk. It's a Google sheet floating around. Now, there's some weird questions about that, which is like everyone on this call knows, because most people here are like accountants. Balance sheets on Google Sheets are weird things. So there's already some weird stuff happening around like what exactly got leaked and everything. But high level, CZ, who is the CEO of Binance, looked at the balance sheet and essentially saw that FTX and Alameda Research was way overexposed to FTT. So they were just immensely overexposed to FTT as a token. So, and he, because of this earlier deal where they rebought some of their stock, he happened to be sitting on this $500 million stockpile of FTT tokens. So in what will be analyzed for many, many, many years as a insane move on his part, or brilliant, or somewhere in between, he essentially sold through all of his FTT and completely crashed the market. And by doing that, he triggered what would be a liquidity crisis on out for Alameda Research, which then triggered a bank run on FTX, which then triggered a insolvency liquidity crisis for FTX. So basically, by kind of shrewdly holding onto this token and then selling through it, he triggered CZ triggered the collapse of FTX. Now, there's also reports of massive fraud, people like using customer funds. There's a report that they transferred a bunch of customer funds from FTX to Alameda Research to potentially orchestrate the Luna. I mean, this is all getting into like deep rumors on Twitter, but like there's rumors that he was the one who orchestrated the Luna collapse using customer funds from FTX. Who knows if that's true or not? But at a very, very high level, like in the course of 7 days, we speed ran a combination of Enron and Lehman Brothers, all kind of mushed up together in one. And today, FTX essentially is in bankruptcy court and is going there. Yoann, did I forget anything?
No, I think it's pretty good. It's pretty good summary, to be honest. It's essentially, I mean, if you forget the 150 sub companies and so on, and under the holding, is you can just think of it as essentially he created both Alameda, so a trading company, and an exchange, and a centralized exchange. And I think the conflicts of interest just popped up and were covered up by some fraud, essentially. Instead of, I mean, you can have actually, you should be able to manage this conflicts of interest, but they just need to be declared pretty clearly. And there's a mix of over leverage and basically fraud that just gets sort of layered over that. So it ends up pretty ugly. And essentially, as a segue to what's happening now, is that everyone's gotten pretty cagey about how much money and the safety of any funds on centralized exchanges now as a result. Because to shed more light on SBF had gained trust from the regulators, had gained trust from a lot of the ecosystem. So if everyone can be full to a degree, then now like basically we're just doing the rounds and asking accounts from every exchange, and then we just we're pull money. I don't know if you want to, Joe, if you're happy for me to just do a segue to an intro to more of the business and so on at the same time, but the context is that so Wintermute trades on 70 venues originally, so 30 centralized exchanges and 40 essentially DeFi protocols. So what we call DeFi protocols, it's centralized finance protocols. It means that we interact with smart contracts in different pools and so on where we can trade. The 30 centralized exchanges suddenly shrunk into, let's say, 5 where we're very active now, and then we're slowly re-expanding as people send their accounts, and as we can, we essentially separate, the very much the exchanges where we should trade and we can trust in trading, and then others where we may have less confidence of trading there, but we may have a line of credit on the exchange and so on. So we're going through that process. And it's an interesting dynamic because it used to be more the other way around. It used to be more, there's a form of partnership between market making firms, so people who provide prices and put a lot of, our, funds on exchanges typically, and the exchanges themselves. But usually, because the exchange essentially brings, the counterparty brings the other side of the trade, they tend to have more negotiation power. And nowadays, it's much more on the market maker side, I would say.
I hadn't thought about the power dynamic changing on this, which is suddenly you guys are going to be greatly in demand, because if you say we don't trust KuCoin, well, that is a major signal to folks that are out there, and that's going to, like, you as Wintermute, you're going to start getting really courted by a lot of these exchanges, and you're probably going to be asked to publicly say where you're trading and like make statements about the reliability and things like that.
You can see that already with, for other reasons, to be quite honest, one of our smaller competitors, GSR, declared on Twitter that they wouldn't trade on Huobi. So it's Huobi is used to be a top 5 Chinese exchange, and then just essentially very, very much lost a good amount of their customers and so on, has been struggling a bit commercially for the last year and a half or so. But it used to be, pretty decent size, exchange as such. And then, some market makers just start to clearly say, oh, we trust that exchange, we don't trust. Kraken, we said publicly on Twitter that we trusted the exchange, and Jesse was more than happy with this.
That's the
Coinbase,
CEO of Kraken, who's been pretty, I mean, he's actually been pretty active in all of this on the other side of it.
Mhm.
He's been making statements. They released a bunch of new documentation. I think he sees a chance to capitalize on all of this, honestly.
Yoann, I
yeah,
get,
I think.
oh, go ahead.
I think that the another, and it's something I need to mention because I think I was wrong with my first assessment. So to give people some people say there's 300, some other people say there's 400 million crypto users overall, and allegedly there's only about 4.5 million DeFi, so decentralized finance users, so people who feel confident to just simply trade from their wallet, or trade through, commit capital to a pool to lend, or trade directly, essentially peer-to-peer. And okay, there's some fireworks in front of my house for some reason now. Apologies if there's noise in the background. So it's still a tiny portion of the space. So DeFi is essentially, so we do 20 to 40% of the volumes in decentralized finance. There's about, let's say when there's $20 billion that we trade, there's about 18 that's in centralized finance. There's 1 billion that's what you would call OTC, so people on the phone, people through Telegram, or people through an API, people who plug into us directly for liquidity. And there's 1 that's in decentralized finance. So it's still tiny as a portion of the space. But you would imagine that if people can't trust custody or can't trust, someone else to hold your funds and trade through that, then you would imagine that there would be more development of DeFi. So I think there was more trading through Uniswap than Coinbase, as far as I heard.
Wow, is that right?
I don't know. I don't know. That's
I believe it. Like I'm 100% with the theory that this is a major turning point for DeFi, because suddenly I think we've proven time and time again that we can't trust that. And I say this, we can't really trust the exchanges to act in our best interest. I mean, that's like us as consumers. And so, whereas, DeFi is spectacular because you don't have to trust anybody. You can literally look at the pool. It is guaranteed to have the liquidity that you're asking for at the curve that you're getting it at. So there's literally no risk of SBF lending it to his sister company to do shady trades on and things like that. Yeah, it's going to be a real change.
Decentralized finance, essentially, you trust the contract instead of trusting the counterparty.
Yeah.
So, and you can see, and this whole dynamic around proof of reserves and so on is interesting when you sort of trying to compare, essentially exchanges to banks. But we can go back to that later. But then essentially in decentralized finance, you can see that on chain. What I've been told very kindly though is that I like to embrace things complex and then think that everyone does, but it's not always the case. So I think a lot of centralized exchanges are very much needed as a gateway to the space. And then people start through the centralized exchange, they get more familiar with crypto, and then they may actually trade through decentralized finance a bit more later. But that's, yeah, we'll see how that happens. I think in terms of the audience, I don't know if everyone trades and is familiar with the crypto space, but I think what's really peculiar with centralized exchanges in crypto is they're an exchange, they're like a prime broker, they're like a bank essentially, they're like they're a whole lender and so on, and it builds a whole set of conflicts of interest essentially between them. Not necessarily, as you said, it's against their own interest, because once they hold your crypto on exchange, they want you to participate in a staking program, in an earn program. They want you to trade more, obviously, but they're very much incentivized in just aggregating, the custody and so on. They're not really incentivized in being too transparent about what's going on. So I think we've seen that a bit too clearly this time around.
Yeah, no kidding. You said so many interesting things there. I think that distinction between DeFi and how you evaluate DeFi versus from a risk standpoint to a centralized exchange, I think is really interesting. Like you spoke to, obviously there's some smart contract risk and there's risk involved in DeFi, but from a centralized, you use the word trust a bunch, like, essentially from Wintermute's perspective, do we trust this exchange? So I'm curious, like, for a firm like Wintermute, how do you approach that risk assessment of a centralized exchange? What kind of information are you looking to see? Is it obviously proof of reserves is all of the buzz right now, but is there more to that equation there?
So the thing is what people can show and what you can guess from the business model as well. So sort of just trying to preempt, conflicts of interest. So people who historically like, let's take two opposite models, like so essentially an FTX and is fairly far from, let's say, a Kraken in the way that, so as an exchange, you can focus on two things. Three things. You can focus on how safe your exchange you want your exchange to be, and on the other side, there's a balance with speed. So basically, the faster your matching engine, essentially, so faster people can trade and agree on a transaction, and then the faster you can process withdrawals and deposits and so on. So you sort of lose. If you want to have more security, you basically lose a bit in speed. The third dynamic.
I hadn't thought about that piece of it, which is that because FTX was absolutely optimizing for speed and other things.
Yeah.
So you actually are you can even just look at their trading engine and see what it is that they are optimizing for. They're optimizing for the client, or they're optimizing for commissions and speed and HFT and things like that. That's really interesting.
So, and this third dimension is about your dimension of how aggressive you want to be in terms of customer acquisition. And the customer acquisition piece, I would say, is more the dimension around products. And so people who are like, FTX they've been really the fastest in terms of product innovation and so on, and I think they had, to be honest, in terms of pretty good products and a pretty good approach to finding the right balance of what's acceptable for, a regulator today or, future regulator. And then you tend to see the exchanges that actually provide a lot more leverage as well. So you provide more leverage. You want, you're happy for your customers to take more risk, so you can get more fees, and you're just happy to, manage liquidations if needed to. So liquidations meaning customer puts, 100 on their account, and maybe they can trade for 1,000, but then if they go too close to the limit, if they lost that money, you just need to get them out of the position. So, and Kraken is the opposite in a way that Kraken's been pretty slow in terms of, because very much the opposite of 10 years. And Kraken historically, for context for everyone, is that Jesse essentially bought some empty box, I think, infrastructure essentially. So they had this trauma probably of the hack, and then basically kept things on the safer side. And then there's pros and cons to both, to be honest. That's the general. That's how you can look at to have a little sort of heuristics around exchanges or their strategy. In terms of Wintermute, we had this growth in the business where we essentially, when you trade on 70 venues, you have a natural diversification, and then you can consider some safe havens or less safe venues as such. I would say that's more the ignorant sort of way of looking at things, to just distribute the assets, and that you can make enough money to cover the 1/70th essentially. There's a bit of that approach is being more and more refined when we finally are in an environment where the power struggle, as we discussed at the start, has changed a bit, so we can actually get a lot more details on accounts from exchanges and so on. So we do demand that.
So you guys are actually in the place where you're going to demand non-publicly available information to basically, before you're going to trade, before you're going to put a lot of money, you're going to ask for like non-public information about positions, like liabilities, all that kind of stuff.
It's true. Luckily, a lot of the exchanges are non-listed, but I would say I think it's more about the dynamic of to give more context. We markets, we tend to trade, let's say we do about 20% of the volumes on Coinbase, 35% on things like Kraken, up to 50% on Bitstamp or so. So if they don't have us there, they've been in trouble in terms of who's going to provide prices there. So it's very much more akin to a partnership than a sort of a customer service provider a relationship. So I would say there will be different degrees where fully trusted exchanges, we can leave funds there. The medium level where we do trade there, but we essentially have a line of credit from the exchange, and then basically the lower grade where we just.
Oh, that's interesting. So there's situations where you actually are trading on their dollars, and then basically, so you're not picking up actual exposure to the exchange itself if they were to go out of business, really, except for whatever profits you're holding in there are or something.
But then it's also transparency on our side about how much equity is in the bank and so on. And we've got the luxury of trading. So as market makers, we provide all these prices all day and of tens of thousands of pairs essentially. So we trade 300 assets across the 70 venues, and essentially we trade 4, 5, 6 million times a day. So it's very granular. So we essentially make money every hour. So it's pretty easy usually for a risk officer to look at to look at us, to take a look at the risk. Yeah. So
go ahead.
No. It's just I was just finishing the point there. So
you said some really interesting things there. So like from a perspective, I'm wondering if Pat, maybe you can introduce the idea of like what type of position a market maker might take, like a market neutral position, because you made the comment of hey, we're on both sides. Like if we're on the buy side of the trades, we're at the sell side of the trades, and so Pat, I'm wondering if maybe you can kind of introduce the idea of a market neutral position versus maybe being directional one way or the other. And then Yoann, maybe you could speak to how you all think about that at Wintermute.
Well, and the context here, of course, is that SPF famously was market neutral. That was sort of like, it's one of the things that I think was why people were so surprised. People like me that like we're in the industry, but I'm not a hardcore trader. Like I just dabble in it. I don't do market making. Like all that stuff is just another layer of depth. But like something that always stood out to me about SPF is that he got his start on arbitrage. And like arbitrage is a disciplined, market neutral, grinding kind of thing. Like every day you are waking up, you are very disciplined about how much you're putting at risk, what you're moving. You've got to they had to keep very close eyes on their counterparties, because in an arbitrage situation, you are heavily dependent on your counterparties not going out of business. So like I always thought of him as a very disciplined person, because it is hard to run an arb shop, which is really what FTX started as. So arbitrage is one way to be market neutral, because you don't care if it goes up or down. You are saying, I have asset A, there's another exchange out there with asset B, the prices are different. I'm going to buy over here so I can sell here, or vice versa. And I'm going to basically arbitrage those prices between them. I don't care if the prices go up or down after that. So that, he was very famous for being pretty insistent on being market neutral. And I know, Yoann, that's also a big part of how Wintermute thinks about this, right?
Yes, so we essentially make sure we help price discovery essentially. So if there's and the price discovery tends to happen through centralized exchanges and goes to DeFi. So typically, what could happen is we buy some Bitcoin on Coinbase, and essentially let's say a wrapped Bitcoin equivalent, because it doesn't trade on Bitcoin on the chain, but let's say on Uniswap, the pool hasn't moved, it's not at the right price, and then we just go and sell it just to put it back in line. So we help just make sure that this price discovery everywhere. So it's one type of arbitrage essentially. So you have two different venues, you have the same asset that trades on two different venues, and you have price differences and so on.
Where did SPF go so wrong? Like how did they get so far away from being market? Because theoretically,
that's a big question. Also, I think there's suspicions of them losing GBTC money, similar to 3 Arrows, them lending to 3 Arrows and some others who've lost money. There's suspicion that they lost money on liquidations on Luna. So as it was just going down, basically, so FTX, I was mentioning earlier, so it's a derivatives exchange essentially. So you could take levered positions, and then someone else. So we were part of that program as well. Don't know how recently, but at least around Luna times, we're part of the program where, as some of the users' positions get liquidated, so they take a directional bet. So I don't know if you wanted to take, an example of positional bets as opposed to neutral. So if you market neutral, you don't really make or lose money if things go up or down. If you're if you take a directional bet, you make money if things go up or down. And typically with leverage, things accelerate essentially. So what
even the act of offering leverage creates a directional bet essentially, like as an exchange.
Yes, because if you have what you call like a dislocation, even if things which are considered market neutral have a dislocation, yeah, you might push someone, or you might be pushed to liquidate. True. So one of the and I'm not 100% sure that that's what happened, but one of the suspicions is that because Alameda historically is linked with FTX, Alameda, so the prop trading firm of FTF, essentially was participating in some liquidations in Luna when Luna flew down, and then just bought, essentially just they continuously bought up things that were essentially just worthless at the end. So lost, if you but there's definitely, well, there's a $4 billion hole that was compensated whatever, or failed by essentially transfer from FTX. So that money has been lost somewhere. They did spend quite a lot of money around for investments, so I think some of it is in illiquid assets as such. But it's still that some substantial amount of money has been lost trading both ways, either market neutral or with directional bets.
Yeah, you brought up leverage a couple of times. I'm curious for both of your perspective on this. If this whole situation was a fire, leverage seems to be gas on the fire, right? It seems to I think you called it like an accelerant or something similar. I'm curious how you think about the use of leverage from like an institutional standpoint, for large institutional level traders. But I'm also curious for both of your opinions, and maybe you'll say you don't have one and that's fine. But, I think about from the retail side of things, like if I log into FTX as a user and they're immediately like serving me, hey, do you want to trade with 25x leverage?
Which is just crazy. Like, it's
it's kind of not.
No one should be offering me leverage. I don't know how the hell to use this stuff.
Yeah, so Pan, do you want to start on this? I'm quite opinionated on that one. So
yeah. Well, I'll just ask, or I'll just add, because I'm not super opinionated on it. I'll add one part to Joe's question for you, which is one thing I don't know is the leverage that we're seeing on FTX and these exchanges. How does that also compare to traditional exchanges? Like, could I go on to TD Ameritrade and somehow get 25x leverage, and I just have never done this? Or is this is like a totally crypto only thing that we're the only people insane enough to try this?
So it's not. So I think there's two very different types of trading, and it's really good that directional trading and market neutral was introduced before. So in traditional finance, essentially, or like you would find in so CFD providers in the UK typically would provide up to like 100 or 400x on some oil futures or so. And then they do have to tell you, because the regulator asked them to tell, that 60 or 70 or 80% of the customer base after 6 months has lost all their money. So they do have to tell you that, which is, and I do not understand why that's still possible, but so that does exist in so traditional finance. From a professional standpoint, if we were not trading cryptos, we were trading rates or so, we could probably have about 100x. My first business 12 years ago in rates, we had essentially 100x. But the big difference, or even for equities equivalent, you can get 25x from ABN AMRO and so on. The difference is that leverage is obtained after essentially a discussion with a lender, which happens to be your prime broker in that case. And it's essentially after giving you a set of rules, a set of risk metrics that tends to be around some value at risk equivalent or so. So they look at the move, or how you're positioned, how you're essentially the different bets that you've taken, how do they evolve with either volatility or simply a shift in the respective underlyings that you're trading. And that can go to 25, but essentially you've built first as a professional trader, as a firm, we essentially built something reliable, and then you can add leverage to it. So I'm going on to the retail side, but I think it's just pretty irresponsible for people to get, you know, as a retail like leverage, because most retail, unless they're doing like a ton of research, diversifying enough and so on, they should see the crypto space as the venture space, essentially. So do you think of being a VC with leverage? Do you think that's relevant? And I think, you know, SoftBank with like a 2x or 3x, I think they've proven that it wasn't necessarily the greatest thing. And it tends to be that because venture, you have a lot of the deaths first, and actually the big ones, the big winners, they tend to be late bloomers, and you don't want to be pushed to sell them too early, and you can only really do really well because you let them run. So if you see the crypto space like the venture space, I think it's just a better way to look at it. And it basically implies that, well, leverage one, when you take directional bets, is basically what you should get to, and like, you know, 100 is probably not very responsible.
It's a good analogy because you're basically, so it's a high volume investment, low number that actually make your portfolio, make your fund.
Mm-hmm.
But then B, it also is that with crypto is a great example where even more so than traditional stock markets, you have an incredibly small amount of control over day, week, month timing of where the market is. Like, I can have very high conviction that Ethereum will eventually be worth $10,000 because the way the network works and the way that you're going to see transaction volume change. Like, you can have super high conviction of that, but like the roller coaster between point A and point B could be 9 years, and it could go from, you know, 16,000 to like 16 cents in between those. And like the hallmark of ventures, you never want to be forced into a selling position. And that really hits with crypto as well. You never want to be forced into a selling position, because that's when you're going to get wrecked by the markets.
Exactly. I mean, Ethereum is a very good example where we saw whatever it was previous peak was about 1,400 in like Feb sort of 2018, I think. So around the highest there, and then we saw $85.
Yeah.
You know, basically a year and a half later. So,
which is crazy. I wish I bought more at 85. Like, yeah, such a deal for Ethereum.
And then so that just says that, you know, anything marginally above 1x of leverage just kills you, basically.
Yeah.
Essentially
that level of a change leverage would have fully liquidated it out of that, right? Yeah.
And it's terrible because actually paying 1,400 would have been good. You know, it was at 5,000, you would still be okay, but you had to sustain and just, you know, staying when it was at 85. Yeah, I think, I mean, I don't know if you guys wanted to segue into DeFi, but one of the reasons why I'm frustrated, but I do like the Uni V2, so Uniswap V2 functions or things like this, where essentially there's a piece of code that says how things should be traded. And it's not very smart, but at least there's a model around it. And people like retail can participate in those pools and so on, and and at least it just brings a framework. It's not the perfect function, but at least there's a framework around it. And it's not something like, oh, I'm buying this at $1 because I think it will go to 10, but then I panic when it's at 60 cents and I just go and sell it at 40%, loss.
Well, I love, Joe, if we like, it'd be great to get a little bit into some we kind of went super deep really quickly, but there's this aspect I think a lot of the people that, like, a lot of Bitwave customers, a lot of folks on the webinar right now might be interested in a more 101 on some of this stuff.
Yeah, like from a market perspective, from someone coming from a traditional, and not traditional institutional level investor, but like, hey, I've got an E-Trade account. I'm used to buying US equities. Maybe, I thought I bought some Bitcoin on the Robinhood app or something, so from that perspective, Yoann, can you speak to sort of the challenges of crypto markets and why it's different? I mean, you've spoken to it a bit, but what special considerations does someone need to have thinking about crypto markets? Like, can you walk up into any crypto exchange and, sell $10 million of a particular asset? What consideration goes into that? You talked about liquidity a bit before. Can you touch on that?
Yeah, so 10 million is possible for ETH and BTC, and then not for many others. So we
Would that be ETH and BTC only on Coinbase, Binance, a couple, or could you go even to like the lower tier ones
No.
like KuCoin?
Well, you would have to go TC purely. You wouldn't go on exchange. So the rule of thumb for like $100,000, we would start per transaction. We would start to take customers on board. We tend to deal with the ultra high net worth to about the $40-50 billion hedge fund on our side as customers. So it's purely B2B. People who are very, what do you call, execution sensitive, so very price sensitive, and you get the best execution through people like us who basically can take the risk on the balance sheet and can take another 2 days to do what we call hedge the positions. Basically, make sure that we remain market neutral overall. We have done during the India relief, for the India relief fund, we've done about $1.5 billion or so of I think it was Doge, but on a VWAP, so basically over time, essentially. It really takes some time. And in September of last year, we had done 2 blocks of $200 million of Solana. It was liquid enough at the time, but still it swung quite a bit, and it's like a 7%.
What's that mean? What's 2 blocks of Solana mean?
So 2 blocks, it means that we traded $200 million a pop, basically per transaction, in September of last year. So
is that like one of the biggest single transactions? You said you had a Doge one that's big too, but is that that's got to be enormous for this kind of thing?
Yeah. We know we have positive expected value on it, but it doesn't always work out. So that's some of the largest trades that we've seen. But to be pretty honest, it's I would say if anyone needs a rule of thumb, is you start to have market impact when you trade more than 20% of a daily average volume. And that's just a rule of thumb in terms of execution. And as for functional markets, it's such that if you can transfer, it's not too difficult to transfer between exchanges and so on. Going back to the 101 is more difference between crypto and traditional finance. I would say there's the freedom, the extra freedoms that you get because you don't have a bank in between, or you don't necessarily have a prime broker in between. You do have to manage. So essentially, the fact that you've got the freedom of, running the custody you want. It's about deciding, okay, do I have the custody with, I don't know, Coinbase custody?
So I got really curious after you said that. So I went and looked, and Ethereum, so Bitcoin's daily volume on Coinbase is 800 million. So kind of rule of thumb is that you could trade around 150 million before seriously wrecking that kind of market.
So if you wanted to build up a buy or a long or short, so basically if you're buying or if you're selling, you would start to impact the market quite significantly.
Okay, that's super interesting. All right, sorry, please continue. This is
interesting. So the 2 very different risks compared to traditional finance is very much this: do you want to do your own custody? And then the questions of cold storage and so on come into play. And it's about how fast do you need to trade. To be quite honest, it's about and trading this similar to the trade-off for exchanges, safety versus speed. And then the second thing that's more about going further down the longer tail of like the different coins and then discovering the universe of crypto. Essentially, is how much due diligence do you have to do on the smart contracts? So these things are programmable and so on, and then it's just how much due diligence you want to do in terms of is there holes in there, and then in some ways just that also gives you some insights on the ones that you find out more resilient and have more growth potential and so on. But there's these 2 things are quite different, I would say, between sort of crypto versus TradFi.
Yeah.
Am I forgetting something obvious? I don't know.
No, I think that's pretty good. Hey, by the way, well, Joe will have another question, but while we're doing this, if anyone has any questions, we're in the last like 15 minutes here. So please feel free to throw in the Q&A question, throw any questions you might have. We'll spend the last like 15 minutes here answering any questions if there are questions. So I think it's fair to say you have a expert in crypto markets and trading on the line here. So if you have any questions about, how your business should think about it, because one of the things that we've worked with a lot of people who are Bitcoin miners or ETH miners or stakers who are doing pretty regular liquidations, right? And I don't mean staking liquidations. I mean like that they're selling through all of their inventory pretty quickly. And there probably is a really interesting question there, which is like, if you are someone like that, where you're mining whatever 100 Bitcoin a month, or let's say even more, like how would you think about selling that? Would you sell it all once at the end of the month? Would you sell it continuously every single day? Would you try to like time the markets and like sell a little bit here? Would you contract with someone like Wintermute? Like how do you think about people who are selling for USD a lot of crypto?
I mean, it's the question of like, how long can you wait? How much freedom, what degree of freedom really? If you have any significant size, you should be onboarded for OTC with us, as long as you're running an honest business, obviously. But if you do, yes, I mean, there's a reason why we trade 20 to 50% of the volumes in all these centralized exchanges, because we do provide very decent prices. It's very difficult in-house to just go and build a similar infrastructure, because we've got 100 people essentially doing that, with 50 essentially quant dev traders. And I would say it's more about, so I think I see some questions coming in, but it's the question of the degree of freedom is, I mean, mining businesses are different from some others, but let's say if you have a mining business and if you're tight in terms of your expenses, obviously you don't want to cover and be quiet. You can be agnostic. I think the important thing is I was joking about this when I was looking at my effects. I tend to be very focused on the business, and I'm like 1, 2, 3 days too late on everything I have to do on my personal effects. But what saves me is I'm consistent. So basically, if you're consistent with the way you hedge, then at least you've got something that you can model and you can try to improve from it. And if you think that it's good for your business to hedge and have some certain amount of certainty, selling things regularly every month or so, that's good. Obviously, if you have more time, you have a lot more optionality. So I know some miners who are nearly, prefer to not run the machines when the Bitcoin was too low, and then basically just buying for the market, to be honest, and not spending electricity. And then people who just just stack Bitcoin basically for the upper end of the cycles, essentially. So that means you have a ton of optionality and a ton of freedom. I don't know. I mean, it's just
how sophisticated an internal operation do you need to have before you seriously look at hedging options? And I don't mean options. I mean like the different options that you have to hedge something like your crypto revenue streams. Do you need to bring full traders on into your operation to do that? Can you work with folks like Wintermute?
You at least need a fairly educated CFO. I mean, the problem is anytime we try to do this, you turn into a trading firm, essentially. So the ones, or at least a macro fund, or someone basically. I think that's the problem with the focus. It's more with entrepreneurs and so than the traders and so, but it's more about what makes it work for a business is focusing on the core and essentially outsourcing everything else. And if it's non-core, it's probably just good to have, a more smoothen result by, so typically the answer here is just, I'm a Bitcoin miner and basically I need to sell X amount. I just need to make sure that I can pay my bills, and I just smoothen I just decide, once a month I'll sell X amount of Bitcoin to make sure that I can cover my bills. But yeah, regardless of the frequency, I would say it's more about having some structure, some model, just to make sure that you can play around with real parameters and stay away from anything magical, essentially.
Yeah.
Yeah, makes sense. I want to call out a question that came in from the Q&A, and then before we wrap up, I want to get your guys' thoughts on maybe some forward-looking stuff, what you're seeing in the market, what you're doing in the market right now in the immediate wake of the FTX situation. But the question from the Q&A was, it's about, self-custody. Like, hey, should I be using a hardware wallet? What should I be doing? And I think, Yoann, you made an interesting point. I think you said, when you're talking about custody and self-custody, I think you just made the comparison of it's this balance of speed versus safety. I think you said, can you speak to that a bit? And I'm curious if you have a personal opinion about self-custody. Like, I'll tell you, like, anecdotally, it's hard to get my mom to, like, set up her hardware wallet, right? And so I think there's still something to be desired as far as maybe a novel solution for self-custody in crypto. So curious how you balance that safety versus speed calculation, and just any thoughts on self-custody and kind of what the need in the industry is.
So a few comments first. So I think there's a set of, I mean, it's a bit like holding your own, whiskey, or holding your own, gold. Basically, it's a bit, it's, who can you trust to do that and not lose the keys and so on. There are solutions out there to make sure that essentially, I mean, we did run into some issues on our side, but essentially we've always had about 5 different persons that need to agree on, so what's called, essentially whitelisting a new address, so you can control where the funds can go and then how much can go at a given time. So you can give a framework around self-custody that's quite useful. It's a function of speed, definitely. So it's a function of how often do you really need to trade, because you do add friction to those transfers. And I would say also it's a function of who can you trust to hold these keys. So if you can generally trust another counterparty, so like an exchange to do that, then you should probably do it. If you can't, and if you need a bit of alternative solutions as such as that, so typically for your grandmother, I think you mentioned that you have, I think it's Argent does this with what they call a guardian. So you can essentially have someone else that you nominate to make sure that if you lose your keys, that someone else actually can unlock the wallet. It's essentially what you're doing with Coinbase Custody and a few others that have good reputation in general, to be honest, not necessarily promoting them, but we do see them used quite often with large either venture firms or hedge funds. And yeah, it's very much a function of amounts. You're happy to put at risk, and essentially the speed that you need.
It's funny, Joe, because Joe, I did the same thing. I gave my family and my best buddy for his wedding, I gave him Bitcoin, but I gave them all paper wallets, and then I took them all back immediately. I'm like, and I'll just hold on to this for you guys, because I don't trust any of you to actually understand that I just gave you a paper wallet worth I just gave you a piece of paper worth hundreds of dollars. So I'm just going to take all these back and keep them, and then we'll just all talk later. My buddy who got married, he turned out great. I think I gave him like $150, and I think when I finally one day I just texted him like, hey man, like your crypto I gave you for your wedding is worth like $2,500 now. Like, you want me to sell it? And he's like, let me ask my wife. And then like 3 seconds later, it's like, yes, immediately sell all of it.
Take the cash. Yeah, that's a good wedding gift.
Yeah, so it's in this case, I was their custodian. But I think what will be interesting to me from all of this is I actually really hope that we end up getting, like, I'm not a huge regulatory guy for crypto. Like, I like that we are making our own mistakes and kind of working through it. And I think that's finding relation stuff. One of the places that I would love to actually see regulation, and I guess you can quote me on this, is I actually do want a really clear definition of kind of custodial versus exchanges that are allowed to rehypothecate. And I think even within exchanges, like a law or a rule from whatever it is, either FTC, SEC, whoever would be writing these, like one of the exchange regulators, that basically is very, very clear on, you know, if you say something like XYZ, if you say we are custody your funds, or unless you explicitly opt into lending your funds or staking your funds, we are as an institution making a commitment to you that we are holding this in an FBO account that is segregated from the rest of the funds, that is yours. And then I'd even like to see some legal verbiage, which I think exists. Like, it exists for banks, but banks get unwound very differently than private companies or public companies. Like, a bank that gets unwound goes into receivership. There's a very clear way that it gets unwound. There's a lot of government agencies that are involved in it. That's very different than somebody who goes into bankruptcy proceeding. So, like, one of the places that I want to see regulation here is I want there to be really clear regulation between, like, what is your funds that they happen to be holding versus what is the funds that you're giving them to rehypothecate and work with, A, and then B, what are like what I just said about that. So that's what I really want to see from regulation here.
Yeah, I think some regulation is coming. We hope it's decent for us, right? This is FTX situation notwithstanding. But I want to close out. We got a couple minutes left. I want to look forward thinking. I'm curious, Yoann, from Wintermute's perspective, you know, obviously it's been chaos the last week. The ripple effects of all this are still playing out now. So what do you see the challenge over the next 6, 12, 18 months? And like what are you doing now? Is Wintermute, you know, you lead the business development side of things. Are y'all investing? Are you sitting on your hands? Are you just watching? Is it wait and see? You know, where are you at now?
No, so I'm happy to say it's probably the best time to invest. There may be another, 6 or 12 months of further winter. The silver lining, or simply just the current assessment, is that a couple of things. We can have bad banks in the crypto space, which is really good. I traded on the rate side through Lehman and so on, and I was just thinking, oh, we worked for this prop firm that no one is going to save if we go bust. Why is, you know, a trader at a bank just allowed to take, you know, excessive risk, and then suddenly it's like they don't have the downside. So we haven't transferred, you know, to the taxpayers. We haven't transferred that burden as such of all these you know, losses. I think that's pretty positive. It's just you know, we're still doing better, or showing a better way than traditional finance, essentially. So that's positive. And on the reshuffling of the space, that's like challenging, but it also shows a lot of there's a lot of opportunities there. I think essentially we're lucky in the way that we dominate a certain segment of the value chain. So spot market making, we do very well, and, you know, we'll continue to gain a bit of market share. A lot of the firms, the teams building somewhere midway in the value chain, so they've grown enough, they're still spending, trying to acquire or keep some customers. And then the risk is that they overextended. Well, many of them overextended themselves last year, and they really need a new upcycle to really succeed. These are going to suffer, not to say just disappear. And it happens, and it will happen to probably more exchanges. And it's more, if you're starting a venture in a space, it's probably quite interesting because you have a lot more reshuffling of the talent. There's still a lot of venture money that needs to be deployed. So I think there's a ton of opportunity to also invest in, you know, in smaller projects, essentially.
Compared to like 6 months ago, right? It's getting to be a little bit easier to hire for sure, which is, I know, I mean, we've got open headcount. You guys have open headcount. Like hiring in this space is hard. Like for Bitwave, it's so hard because you're hiring blockchain experts and accounting experts, which is like insanely difficult. You guys are hiring blockchain experts and crypto and trading experts, which is hard. I'll add one thing to this, which is that I had this really interesting conversation yesterday with someone who was comparing this whole thing to 2008. And what he said was he remembered something that was really important, which is the Fed chair at the time was a study of history and had remembered that one of the issues that caused the Great Depression was that we allowed banks to fail during that. So like basically 1929, all this stuff starts happening, banks start failing. That actually created a deflationary cycle, and it exacerbated everything so much more. So his learning when 2008 came around, that was why we went and we actually gave money to stop banks from failing outright. We lent money so people could buy banks. We actually backstopped the whole industry, we being the federal government and all of that. And so he made the point, like, well, there's no one in crypto that could do that. There's no one that's learning from history. And my response to him was like, it's super interesting. It's a really good point. The issue was that for all of this gentleman, I forget who it was, Tim, the Fed chair at the time, whatever.
Greenspan.
Was it Greenspan back in 2008?
Probably still Greenspan, yeah.
Yeah.
Tim, the former, I don't know, I think he started around, he may have started around 2008, to be honest. It was sort of end of Greenspan and
so but the point is, like, with all of this history and all of this wisdom and all of this hindsight, we still was it Bernanke? Yeah. We still failed to prevent 2008, right? We still managed to get ourselves into the absolute worst, the worst recession of our lifetimes. We had all these banks fail, like even with the historical relevance, we failed. And so I think it's actually one of the interesting parts about this is that crypto has put so much more onus on the users, the traders, the individuals that are involved in the space, that I think we actually are over time here going to push harder to actually be more proactive about preventing institutions from failing. Because even today in America, we still operate with this assumption that there is a backstop. There is a government that will ultimately save our lives or save our banks if we need to. But I actually think one of the innovations will be seeing more businesses demand, like what you're doing, demanding proof of reserve, demanding liabilities up front. There's a very real world where that we can actually do more we can demand that we have more ability and more transparency into the financial institutions that serve us. And that maybe we actually could get to a world where we do avoid the next 2008 instead of just having some of the backstops and kind of saves on the other side. So I'm expecting innovation around this, proof of reserve, proof of liability market that we're seeing here. Doesn't mean we're gonna get rid of fraud altogether, but I'm hoping we see innovation there.
Yeah, I think, as a reminder, so Lehman had 56x in leverage. So it's not like you couldn't see it coming, and some of it was just off balance sheet, to be honest. So it's, AIG was there a bit before that and so on. So it's just like pretty significant excessive leverage. Like you can still have a ton of growth. You can still have reasonably like good leverage without, going bust, to be honest. So yeah.
Yeah, that's great, guys. So I know we're over time here. I just want to say thank you. Thank you to Yoann and Pat. Thank you so much. This was super informative. This is such a deep topic. We could go 3 hours on this. So, thank you everybody for joining us. You can find, Bitwave at, on LinkedIn. We're on Twitter, we're all over the place. Yoann, how can folks, find you or Wintermute or get in touch?
Wintermute.com works. We're quite active on LinkedIn and very active on Twitter nowadays. There's a lot of discussions, shifting on Twitter. I don't think many of the crowd is necessarily looking for investments, but we also always look for co-investors and so on. So we're quite active on the venture side. And yeah, feel free to, if you have any, OTC blocks or so, if you're curious about trading OTC, then feel free to reach out to us, to be honest.
Great.
Great. Well, thank you, Joe, for moderating. Great job as always, buddy. And thank you everybody for coming out today. This was fun. This was a fun little exploration of what's going on in the world right now.
Yep. And for folks that want a deeper dive onto the custodian side of things, we are doing a webinar November 22nd. So you can look for that on LinkedIn. I think we're calling it Building Better Custodians, obviously a hot topic right now. So that's Tuesday, November 22nd for anybody interested.
Awesome.
Thank you so much.
Cool. Thank you so much. Thank you.